Hello, everybody, and welcome to the Cyclical Investors Club YouTube channel. My name is Corey Kramer. Today, we're going to be analyzing Snap-on stock. I believe these guys make tools. This one came in by request down in the comment section of one of my other videos. If you have a video you would like me to analyze on the channel, or a video, if you have a stock you would like me to make a video for on the channel, just drop it down in the comment section. If it's in the S&P 500 like Snap-on, I'll make a public YouTube video, and if it's not, I post the rest in Patreon, which is $5 a month. And if you join there and you ever decide to join the full Cyclical Investors Club service over on Seeking Alpha, you can get a big discount. As always, this is not individual investing advice. This is just how I analyze stocks. So, we have a Snap-on. This one is pretty interesting. I hadn't looked at it since December when I last updated it, so it wasn't fresh in my mind. But I always start by looking at the historical earnings patterns here and what they've done historically to see how cyclical they are, usually is what I'm looking for, and just to see how good they are too. What we see with Snap-on is really solid long-term secular earnings growth, with really one or two hiccups, really just one big one during the Great Recession when earnings fell 45%. So usually 50% is kind of the threshold that I use to consider something like a deep cyclical business, and they don't quite meet that standards. And also, other than that 1 year, I mean, they've been really solid, and I'm pretty sure they had a nice run up into that year. If we go back and look, I mean, they had 58%. I mean, they grew basically 100% in 3 years before they fell. So, really solid. But it did sell off quite deeply. I mean, we're talking like PEs aren't particularly useful during these type of downturns, but they were still earning, still based on pretty high earnings here in early 2009. And we can look at the distance here. This will come into play here in a minute, so you can see why my recession buy price here is going to be pretty low. So it fell more than the market, right, during that time. This is probably, this doesn't measure perfectly from peak to trough, so that's probably more like a 70% decline from peak to trough here, which is much deeper than the 50 or 55 that the S&P 500 fell. So that's worth keeping in mind, but everything else looks really, really strong here. I think during COVID, they had another year with, a little blip, which again was a recession year as well. Earnings only fell 5% for the whole year. So really strong earnings, really high quality business. I mean, nothing jumps out at me. I mean, you don't see a bunch of debt. You see a great credit rating. Everything just really looks good. So it meets all the kind of quality standards that you want for high quality business. There's always questions, how much their tools and everything are going to be in demand. But so far, they've managed to keep, demand pretty high. So if you ever watch their, I think he's retiring now, or he retired, but their CEO, and I'm sorry I don't know his name, I just go from memory from when I see him. I just really love listening to him because he's pretty straightforward, but he's definitely like a salesman, and it just harkens me back to like, I wasn't alive in like the 1960s, I was born in the 70s, but I mean, just to like the 60s or 70s or even like the 50s, like just classic sort of business salesperson, and so it just cracks me up whenever I watch him. So I don't know, I think I saw on Bloomberg just briefly that maybe he was retiring or something. So don't hold me to that, but I just wanted to put that out there because whenever I see the stock pop up, I think of him, and it kind of puts a little smile on my face. So all right, so what we want to do here is try to see if we take their earnings growth during this time period from 2015 to 2024, figure out what that is, look at their valuation, which is trading at a 15 PE compared to the market, which is probably more like 22 right now. I mean, it looks reasonably cheap, probably because, well, we can see the earnings growth expectations are pretty low for it right now. And so the market isn't expecting like a lot more growth, but the valuation looks like it reflects it. So when I run the numbers on, I can see what Fast Graphs has. I can see the difference. I like to run my own earnings growth numbers. I like to take into account buybacks and these dips, even though it's a small one. So we'll see what they have. So they're at 1037 for earnings growth during this period. That's actually going to be very close to what I have. I'm at 985. So really that 5% decline year is the only thing probably that affected my earnings growth compared to just a straight up point to point fast graph. So fast graphs will measure from here to probably here. I don't know if they go here or if they look forward or not. I think they look forward if you set the time frame here. So, and I would have taken into account this decline. But basically 10% earnings growth. So pretty simple. You have a 15 or almost 16 PE trading at, and maybe just a tiny bit of debt, yeah, and trading at or with 10% earnings growth. So the way I like to think about this is how much money could I collect in earnings if I own this business from the earning on if I just bought the whole thing for like $100, how much money would I earn over the next 10 years given the price that I'm paying for those earnings now and the 9.85% earnings growth rate. So I do take into account debt, but it only is going to add about $10 to the stock, so not very much, 3%. So it's pretty negligible. It doesn't really matter too much. But if you're trying to work out the exact numbers, then that's what it would look like. And I'm using the forward earnings for next year, which are 1915 right here. Okay, so I'm pulling those forward. So if we bought the stock today, I'm treating it as if it's $303 per share. And we would get a 6.31% earnings yield. So the way I think about this is if I paid $100 for the business, it would earn $6, and I pull that first year of growth forward as well, which we'll see here. So instead of $6.31, we would earn $6.93 that first year because I'm pulling that first 10% forward. Is if I bought that company for $100, it would earn $6.93 the first year, and then that $6.93 would grow at 9.85% each year. And what I want to know is how much would I collect on my $100 over time. So importantly, the $106 doesn't grow at 10%, just the $6. That makes a big difference. Usually people ask me about that if I forget to mention it. So if we go forward 10 years, which is right here, we would earn back about 210. Our $100 would go to 210. If we put that in a CAGR calculator, it comes out to, so that would be $100 growing to 210 in 10 years. It should produce around a 7.69% earnings CAGR for 10 years. That's actually pretty good right now. 8% is my typical buying threshold. And so the stock trades at 294. That threshold would be about 281. So would only have to fall about 5% to get down to that level. Now, what this doesn't take into consideration is if we have a recession similar to the one in 2008 and 9. So we kind of have to make a choice with this one. And right now, I don't think it's a particularly clear choice, but I'll kind of lay out my thinking behind it. If we do have a similar recession, then the stock price I'd be aiming is much lower, because the stock we saw fell maybe like 70% off its highs, and it's probably somewhere near its highs now. So we are looking at a much lower potential buy price if we knew there was going to be a recession, or if we were really worried about it. Given what's been going on, there's no signs of a widespread recession right now. I've kept my recession risk on, and I'm probably going to be modifying it a little bit soon, because there are parts of the economy that are definitely recession sensitive, and then there are parts of the economy that I don't think right now are even going to be close to like being recession sensitive. So some of the more service-oriented parts of the economy, especially the ones that are serving wealthier, older people, are probably going to be much more resilient no matter what happens, basically. So, but the rest of the economy, it could definitely be more cyclical. The parts of the economy that whose customers are middle to lower income could definitely be affected by the higher interest rates that we see now. Could be affected by higher debt levels and default ratio and things like that affect the people that don't have as much money. So I think we're seeing more of a bigger split in the economy coming if everything kind of stays how it is now. So it makes it tough for a business like this, where if you think of like tools, especially like auto tools, I don't know all the details of exactly what they do, but I know they make like high quality tools for that, like a professional mechanic or a really serious home mechanic would use. I don't pay up for the tools that are that expensive, but I mean, I'm not a full-time mechanic either. So the question is, well, what category would these guys fall into? And I don't know. I own a stock like AutoZone, which is kind of in the same position, where new cars have gotten really expensive, and so people are keeping their older cars longer, and so they need more work, but it's kind of expensive often to go take your car to a mechanic. And if you have a house with a garage or a buddy and a yard or whatever, then using AutoZone's products and services are more attractive than a mechanic if it's something that you can do yourself. And a lot of people have done that. So since I own AutoZone stock, I've done really well. And I'm not really planning on selling it, even though the risk is definitely there that they've kind of pulled forward some of that demand. So I think maybe Snap-on could be in a similar position where, yeah, they've probably pulled forward some. Let's look at if I can pull the fast graph up. So yeah, I mean, we have their biggest earnings year was 2021. Granted, it was coming off a weaker year here, but 28% growth, and then 13, which would have been, in line with back here, and then 12. So I mean, 50% growth in 3 years. It's not as big as like before the Great Recession, right? So it's really kind of hard to say. And I haven't made my mind up on it, but here's what I think. I think if a person wanted to buy this at the 281 mark and just commit to holding it, or maybe if we do have some bad recession, maybe buying another round of it if it sells off, like 60% or something. I think that is probably an okay strategy. I'm not quite comfortable doing that myself yet, so it's hard for me to like really recommend it. But if a person had extra cash, I think they could, and they're feeling like maybe they wanted to put more cash into the market somehow or get it invested somehow, as long as they understand that this could be really recession sensitive, even a mild recession might disproportionately affect these guys a little bit. It's really hard to say. As long as you know that going in, then because who knows when that will happen next. I mean, we don't really know for sure. Then I think there are definitely worse places to put your money in the stock market, is what I would say here. So definitely looks fairly valued, as long as you understand that it could be, if we have a repeat of 2008, it could suffer a significant drawdown. Then it might be okay at that 281 price. I haven't quite come around to that yet myself personally, so that's how I would kind of frame all that. It's a good one to look at and really think about. I haven't quite thought about it too much. Now, growth is expected to be slow this year. That's probably good if expectations are already pretty low. They've had periods like that before where they had some really good growth in a row, and then they kind of had a slow year in 2019. So, I mean, that happens. That's just a normal part of business. It definitely looks like it's priced into the stock already to me. Okay, if you found this useful, hit the subscribe button. I also have a 25% off link to Fast Graphs, which is this charting service here that I'm using. I've used it 5 or 6 years. It's really good for doing these earnings style analysis like I'm doing now. If you're interested in doing that, you can use the link in the link in the code down in the description, and you can get 25% off. So hope you guys found this useful. If you have a request, put it in the comment section, and I'll see everybody later. Bye.